Welcome everyone to another of our investment manager videos, and many thanks once again for tuning in. Time is flying by. It's June and we're now closing in on the end of the first half of 2021. So how have UK equities fared so far this year? Well, to help answer that question and many others, I have friend of the channel once more on, David Ridland, manager of the Castlebay UK Equity Fund, and soon to be tearful Scottish football fan when Phil Foden scores an absolute worldie tonight in a 4-0 victory at Wembley. You heard it here first.
That's right, you've had a good first.
Absolutely. First, before we get into the content, if you are enjoying all of the videos that we post, it would be fantastic if you could show your support by subscribing to the channel. It really does genuinely help getting out our investment management and financial planning content to the world. So onto the content, and it's great to see you again, David. Thanks very much for sparing us your time. Kicking things off, inflation prints are increasing globally. What are your views on inflation, both generally and in relation to the fund?
Yeah, I mean, it's an interesting question, Andrew, because if you think about, well, first, it's probably best to answer what is inflation. I mean, it sounds like an overly simple question, but obviously it's a year-on-year increase in prices, and obviously as we've progressed this year and we're trying to fight our way through the pandemic, given how weak the economies were last year, it's to be expected that as we see the light at the end of the tunnel and economies gradually get back to normal, that you're likely to see some upward pressure on prices. Frankly, the extent and how much that happens is really, really difficult to judge. Some people try and do it. We try and avoid doing that. But if you look at how we manage, when we were talking about this before, we try and invest in quality businesses and not overpay for the privilege of investing in those. So that quality value approach, I think quality sets you up really well. One of the ways in which we look at this is there are kind of 3 ways to win and one way to lose. So already we think that the probabilities are hopefully stacked in our favor. So what do we kind of mean by that? Well, first of all, in an inflationary environment, when your prices are going up, your cost base, if you're a company and your cost base is increasing, those quality businesses often do something special, and that gives them that kind of amazing thing we call pricing power. So they can put their prices up and people will still want to buy their products. So brand values that people trust, etc. In a recession, people still brush their teeth, they still hopefully wash and wash their dishes and do all the laundry, etc. So these products have a stable nature, and because people trust them, that they will pay more for those goods. So that allows businesses in an inflationary environment, those good quality businesses, to put their prices up, hold on to their margins and their returns. Mm-hmm. Now, I don't know if you noticed, but I started my career on the Japanese equities desk. So when you talk about price instability, that's inflation, but it's also deflation or disinflation. And I started towards the end of the lost decade in the 90s. And the really good example there is, if, say, you were wanting to buy a car and you think, well, hang on a sec, prices are falling. Do I want to buy it this week, or do I want to wait the next, for the next week or the month or whatever, because I know I'm going to get it cheaper? Now that is really challenging for the economy, because obviously people delay their consumption, and as we know, consumption is such a large part of the economy. So again, if you've got those quality type businesses and prices are coming under pressure, but you've got that stable demand, that helps you continue to hold on to those returns and your profitability in that environment. And the third option is like a steady state, if you like, where we've been, where inflation is either low or just sort of ticking along and it's not really a concern. Yeah. All the while these businesses are reinvesting at high rates of return. The one way to lose, I should just say for completeness, is if the market starts valuing these quality businesses to such a high extent that there's a risk of a derating. That's the kind of one way to lose, but it's what we're always trying to balance when we're investing in that quality and value mindset.
Yeah. Moving on and focusing upon obviously the quality and value, and then bringing in growth as well. There's been there's been a rotation and then a kind of re-rotation in and out of value and growth this year. What's your thoughts on this?
Yeah, do you know what? I think it's a fascinating subject, and because in many ways, I mean, if you look at our, I mean, we sort of think it through our sort of lens, if you like. So that quality value, but we've got growth in our philosophy and our process as well. It's maybe a slightly different growth. People often think about high earnings per share growth when they talk about growth businesses. And in a low growth environment, and this is going way back to, following the global financial crisis in 2008 and 9, we've been in a low growth environment. So any growth has been well rewarded. That's why growth as an investing style generally has done so well over the time period. And, deep value investing has really struggled. So, but our growth comes from the reinvestment at high rates of return. So a business that's earning a 40% return on equity, if it retains all its profits and it can reinvest that, that's the rate at which the shareholder equity base will grow. Now, that's a high growth company in anyone's view. So it's an oversimplified picture that when we talk about growth and value. But certainly there's been that pressure on deep value, and with as I say, that light of a recovery ahead, it's been eased. So you have seen some of those lower quality businesses recover. But Andrew, the really critical point to highlight here is in which direction is the intrinsic value line of each of these businesses headed? With a low quality business that's being offered a seemingly very attractive, deep value valuation, you require the market to re-rate that, but the intrinsic value line is heading down. In other words, these businesses are in perfect competition, and the excess profits are often competed away. So time, critically, is not on your side, and that's a key consideration. We want as investors for time to be on our side. So we want that value creating line, if you like, to be heading in the upward direction. And again, that always brings us back to investing in quality businesses.
Yeah, absolutely. And it is that focus on quality that certainly sets you apart from your peers. And again, looking at the fund itself, you recently talked about the magic of compounding in your investment letter. Can you explain how your fund benefits from this specifically?
Yeah, absolutely. So I know you've come across Morgan Housel, and he wrote The Psychology of Money. It's a brilliant read. And one of the key thoughts he comes across is when you realize about the magic of compounding, you realize that it's a function of time. It comes back to, or extends on the point we were talking about time being on your side. So rather than looking for necessarily the highest return, and that could be the highest growth business or the highest, the most profitable business, your mindset changes, and instead you're looking for a business that you think can sustain good returns for the longest time period. So the businesses in which you have the greatest confidence that what's happened in the past can continue. And certainly when the market was selling off businesses like Diageo and Intertech in the first quarter of last year, they fell 30-35%. We saw that as a great opportunity to invest in these businesses in which we had a high degree of confidence, but previously, before the crisis hit, they were being offered to us too expensively by the market. So that risk that we were talking about of derating, we thought was too high. Yeah. Then suddenly the shares were presented to us because we'd done the analysis and defined these are quality businesses, but we want to buy them at the right price. That's when we came in and we could push the button and buy those businesses in very short order. So it's a critical mindset. So you're looking, again, it's about sustainability of returns. And as you say, we've written about this in our recent investor letters. And one of the examples that we give is if you've got a business on a 40% return on equity and one on a 30%, both very high returning businesses. But if you're much more confident in the 30% and then in the future of that business, that's going to be the better investment over time in relation to the 40%. And another really good example that people kind of will probably be familiar with, Warren Buffett, obviously the sage of Omaha. I think he's now reached his 10th decade. He's just turned 90. I had to look up what that was. I know what an octogenarian is. It's a nonagenarian, I think that's right. So he's in the 90s, and he's worth over $80 billion. He's one of the wealthiest people, and certainly one of the wealthiest investors. But critically, he's made over 95% of that wealth just in the last decade or so. In other words, time, and because of the nature of returns, the sort of geometric nature of returns, getting a bit mathy for a sec, because of that element, it tends to be back end loaded. So you want businesses where time is on your side. And again, without laboring the point, that brings us back to these quality businesses, the 10% of the market that's doing something different, rather than the 90% of the market that we think, is in perfect competition, is always competing, for the scraps at the bottom of at the bottom of things.
Absolutely, and again, focuses upon the long-term nature of investing, being an investor and not a speculator, which I think is really important. In these fascinating markets that we have. So then, to finish off, first half of 2021 has been interesting. How would you give your UK market scorecard for the first half, and then what you're looking towards? How do you think we'll fare for the second half of the year?
For the market in general?
Yeah, UK equities.
Yeah, so I think the UK is really attractive. I mean, one of the things we've said is there's been, and this is partly a political aspect, with Brexit, post-Brexit, etc. But I think we've moved through that. I think obviously the UK's dealt well in terms of the vaccine rollout. So suddenly you've got a developed, economy, the market of which looks really attractively valued. Certainly in relation to the US and other developed markets. So I think that's a real positive. So I think there's plenty more, in the tank, if you like, from a valuations perspective.
Yeah.
And then on top of that, we look at our fund in the context of the UK. We're really excited, actually. Probably more excited than we've been for a long time, because we think we've got, the returns suggest that we've got twice the quality. That's underpinned by half the debt in comparison to the UK market, and it's actually on a higher free cash flow yield. So the valuation, we think, in relation to the UK market is more attractive. So we've always got a double benefit in terms of the UK market's attractive in relation to other asset classes and equity geographies, if you like. And within that, our fund, we think, is quite well placed.
Fantastic. No, well, it's great. It'll be great to see how you continue to perform. It'll also be great to see when this goes live whether my prediction of a 4-0 victory comes to fruition, or whether or not I will get loads of stick in the comments after about being completely naive and being your typical England supporter, massively bullish. Who knows? I'm going to be sitting and watch it with a Scottish wife and 3 Scottish sons.
I know. You've got to play your hand carefully, I think.
David, once again, it's absolutely fantastic to speak to you. You stay safe, and I'm sure we'll catch up soon.
That's great. Bye now.